So 30 years in subscription software business experience. CEO twice, head of marketing, sales, services, and customer success 5 times. 2 total burn downs that we return pennies on the dollar, 5 exits, 2 strategic, 2 private equity, and 1 IPO. So I've got a lot of scars of what I did wrong. So I created this company to try to show how metrics can help inform your decisions in your journey, coupled with using external benchmarks to kind of say, how am I doing against companies like mine? Because so many of the benchmarks out there today are too generic. What you want to know is for a $5 million company with a 25 ACV product with a sales-led motion selling to enterprise customers, what should my CAC payback period be, right? That's more important than CAC payback period should be 12 months. Like, why? So here we go. So over the next, using Nathan's framework, over the next 20 minutes, I'm going to talk about the 5 key pillars of enterprise value and the metrics that are part of those that's going to drive the most enterprise value return for you and for your shareholders. We're going to talk about those efficiency metrics, the top 5, and then we're going to talk about the benchmarks for each of those. Now, these benchmarks are about 9 months old. We're doing our 2023 benchmarking as we speak, so in late April, I'll be publishing the latest 6 months of benchmarks so that they're really current, because Q4 22 and Q1 23 are going to change a lot of those efficiency benchmarks. So let's start with section 1. I'm just going to get right into it. We had to, when we created this benchmark index, we had to create a framework that took all those metrics we talk about, CAC payback period, net revenue retention, and how do they drive enterprise value, to the question over here earlier. So we broke them down into actually 5 enterprise pillars of value. 1 is capital efficiency, and by the way, you'll get these slides. You can also go to revopsquare.com and get all of this. This is what I call my SaaS performance metrics framework. So capital efficiency. This is what you, as a CEO, if you're bootstrapped, or your investors are going to know. For every dollar I'm putting into your company, how's it providing enterprise value? Second, at the bottom, operational efficiency. How efficiently am I running my operations? What's my gross margin for subscriptions, for services? What's my sales and marketing as a percentage of revenue? These are all operational efficiency metrics that investors really care about. An example. Biggest SaaS company, Salesforce, right? Their sales and marketing expense to revenue 4 months ago, 46%, with a 17% growth. So now they're at 36%. Why? Because investors said your sales and marketing expenses are way too high. They were not operationally efficient when it came to growing revenue from new customers and existing. And then you have to look at the 3 motions that impact revenue. So you look at what are the metrics that measure customer acquisition, customer retention, and customer expansion. And when somebody says, well, it's all about customer expansion day, and you ask them, how do I measure the efficiency of my customer expansion motion? How much money do I need to spend to get $1 million or $5 million of revenue from my existing customer? Most people are not effectively measuring customer expansion efficacy. So what I did is I took all those pillars of value and kind of created this. Where do they overlap? So these are the 5, actually it's 6, metrics and benchmarks we're going to talk about today. Number 1, Rule of 40. And we'll talk about how that drives enterprise value. But it's now the number 1 SaaS metric as correlated to enterprise value in the next 12 months revenue. A year ago, it was number 5. Growth is still number 2, but balanced growth with profitability is number 1. We're going to talk about the CAC payback period, the CAC ratio. CAC ratio to me is superior to the Rule of 40. Why? I'm sorry, the SaaS magic number. Why? Because you can measure how much sales and marketing investment you need to make for $1 of new name ARR, and how much sales and marketing customer success investment I'm making to get $1 of expansion. CLTV to CAC ratio, important, but not until you're a little bit bigger. If someone says, I'm concerned about your CLTV to CAC ratio at $1 million, you need to wonder why you're working with that person, because it's pretty meaningless, and I'll tell you why in a minute. Net and gross dollar retention, or some people outside of the US call it gross revenue retention or net revenue retention, and then of course your CARR growth. Okay, I'm going right into the meat of it, CAC payback period. So this looks at how, when you invest sales and marketing dollars to get new ARR, and it's new. It's not new plus expansion. CAC Payback Period is all about new ARR. So it looks at how much sales and marketing investment you're making, divided by how much new ARR times your gross margin for the subscription. CAC Payback Period should always be a gross margin adjusted calculation. So why did I show this? Because you can go onto the internet, you can go to the SaaS CFO, you go to RevOps Squared, or the SaaS Metric Standards Board to see the standard calculation for all of these SaaS metrics we're talking about today. You can do the calculation for yourself. The question is, what does it tell me? So these are the latest benchmarks for CAC Payback Period, and these are segmented by ACV. Because whether you're a $5 million ARR SaaS company or 20, that has a lot less correlation to CAC Payback Period than the size of your average annual contract value. If you're a 5K product, right, you're gonna have a much shorter, and if you're a 100K product, you're gonna have a much longer. So what this shows you, I'm not gonna read it all to you right now, but the middle point is the median. At the end of the bottom of the bar, it's the 25th percentile, and at the top, it's 75th percentile. So what you can see here is if you're a 1 to 5K product, you've heard 12 months for CAC Payback Period. We've been talking 12 months for 5 years. That's the only time 12 months is kind of at the middle, your average, right? Because if you're at the 100K or greater, CAC Payback Period, 22 months at median. Why? Because it has much more of that enterprise motion, and it's okay that it takes almost 2 years to pay that back. Right now, as far as the latest benchmarks, I've looked at about 20 companies, so it's not statistically significant. It's decreased about 15% so far in the first 2 months of 23, but it's so small data set. I can't say that's going to be consistent. And why? Because people have reduced their sales and marketing expenses, so the CAC Payback Period is starting to compress. So before I go on for CAC Payback Period, any questions about CAC Payback Period? Understand it? So one of the top 5. The only reason I show this, it's by ARR, right? You'll see that there's a lot more consistency on the ARR side, except when you hit kind of 10 to 15 million, it gets more difficult to acquire new customers. Why? You've hit the cream of the crop. Now you might be getting those early majority buyers. If you look at the Crossing the Chasm technology lifecycle adoption curve, so you'll see your CAC efficiency actually go down, starting usually at 7, 10, 15 million. And it takes a while to get that back down. Why? You're often also entering new markets. Oh, I was really good in the commercial marketplace, but I got to go up market to the enterprise. And that inherently is going to decrease the efficiency of CAC, which is why any of these metrics I'm talking about, once you get to 10 million, measure them by cohort. Know your enterprise customer acquisition efficiency versus your commercial or mid-market versus SMB. Because if not, you're going to enter into enterprise and your CAC Payback Period just went from 8 to 15 months, and your investors are like, why in the hell did that happen? Oh, it happened because I'm investing so much in this early stage of the enterprise that it makes it look worse on a blended basis, but my mid-market's still very good. It's still at 8 months. Make sense? Okay. CAC ratio. How many people have heard of CAC ratio before? Okay. How many people use magic number as your revenue efficiency metric? Nobody. So CAC ratio has 3 versions. One is the blended CAC ratio. And blended CAC ratio is I take my total fully loaded sales and marketing expenses, and I divide it by the amount of new customer ARR plus existing customer expansion ARR. So that $1.33 you see at the median to the far right, in 2022, companies were investing about $1.33 of sales and marketing expense fully loaded. That means comp, benefits, everything, to get $1 of new or expansion ARR. So if someone says, well, we got to grow 5 million this year, it's like, well, 5 million times 133 it's going to be about $6.5 million, right, that I need to invest in sales and marketing if that's my historic CAC ratio.
What's magic number?
Magic number is the, number one is the inverse. So it takes current quarter revenue, total revenue, or ARR, subtract previous quarter, ARR. What that means is factoring in churn, down sales, new plus expansion, and you divide it by sales and marketing expenses. So it's just the inverse of this. However, the beauty of the CAC ratio, oops, if I can. The new CAC ratio. New is very different than the SaaS magic number. New looks at how much sales and marketing expense did I invest to pursue new customer logos and ARR from those new customers. So you see it's much higher. It's $1.58 because it's harder to grow ARR from new customers. But if you go to expansion CAC ratio, which is organic expansion, so if you have a usage-based pricing or PLG, but it's more upsells, cross-sells, where you actually have a sales-led motion, look at that median, 69 cents. So if you measure, and we'll let you ask a question, if we measure expansion CAC ratio, now it's like, oh, wait a minute, maybe I should put a little bit more money in the upsell, cross-sell motion. Maybe I should have sent SDRs to go into existing accounts and identify that cross-sell opportunity because I know I can grow more effectively. The biggest question is, how in the heck do I know how much money I'm investing towards customer expansion versus new name customer? Because it's like I got one demand gen person and my salespeople do both, right? So there's no perfect model. So don't let perfect get in the way of good enough. One of the things you can do is just do a time study. Just ask your customer success team, how much time do you spend on onboarding engagement versus kind of trying to identify upsell, cross-sell? Ask your AE, how much time are you spending with existing customers on cross-sell, upsells? And it's like, I'm spending about 30% of my time. That's good enough to start until you get enough scale where you might have dedicated people who do growth marketing, or you have an account management team for upsell, cross-sell motion. Any question about new or expansion CAC ratio?
Do you usually look for the last 12 months, or what is the time window?
It depends on your ACV, but you should always do this on a rolling basis. We recommend 1, 3, 6, 12 months rolling. You will see some anomalies if you are selling 25K and above product and you get that whale that comes in for 200K, you're going to see an anomaly if it's in one quarter. So that's why we kind of recommend 12-month rolling. Ben, would you agree on that? 12-month rolling?
Yeah, definitely every month rolling, and then I line it to your average sales cycle.
Yeah. And by the way, on SaaSmetricsBoard.com, which is a standard setting body, there's these recommendations on how to measure it, but also timing of that.
What was that figure in 2022?
$1.33 of sales and marketing expense for every dollar of ARR. Is this valuable so far? Yes. Okay, gross dollar retention or gross revenue retention. We know what that is. It looks at a cohort of customers from a year ago and what was their ARR. And now you look at it and say, oh, what's the ARR from that same cohort of customers, excluding upsells, cross-sells, or expansion. So you just want to see how they're performing without buying more product. So typically you'll see a median somewhere around that 85, 86, 87%. And it's really important if you, in any of these metrics, know how you're calculating them and make sure your investors understand. But the best practice for gross revenue retention is you only measure it for that cohort of customers that actually had an availability to renew. So ATR is what you hear it referred to as. So if you have in Q1, you had 80% of your customers that were available to renew, those are the 80% of customers you use for this calculation. If you've got 20% of your customers on 2- and 3-year contracts and they're not available to renew, it actually biases your gross dollar retention number. Any questions on that? Net dollar retention or net revenue retention. The difference here is it takes that same cohort of customers from a year ago, and now it includes not only churn and downsells, but any expansion, upsells, cross-sells, organic expansion. And by the way, you'll see the median here, and you might say, whoa, Ray, what are you talking about? Snowflake's 168%. That's best in class. Or Twilio's 154% net retention. Do not benchmark yourself against companies that have a different pricing model. If a company has usage-based pricing in the enterprise, and they kind of use that hyper land and expand, it's a free product until you start using it and then you pay, that's how a Snowflake or a Twilio gets 150, 168%. If you're a true annual subscription, seat-based or whatever other, you are going to be more in that 104 to 110%, especially early on. So never benchmark yourself against a company that doesn't share your company profile attributes. It makes you feel bad and it's misleading. Any question about net revenue retention?
What if it's a mixed model? You have per seat and per usage?
The answer is hybrid, no. You should look, if you can benchmark, for people who have both. In fact, our benchmarks that we're just doing right now has purely subscription, purely usage-based pricing, or hybrid. Ben, are we done? About 3/4. Okay. CLTV to CAC, customer lifetime value to CAC. Number one, it's very important that you know how to calculate this because it factors in multiple variables. Not only your customer acquisition cost, but also your churn rate, also your gross margin. If you haven't had at least one, but more appropriately, 2 renewal cycles, this is a meaningless metric. Why? Because you really don't know what your churn rate is. I was talking to a founder the other day, and he's like, I have like a 28 CLTV to CAC. And you can see that kind of 4 is the median. It used to be 3, now it's 4. I said, well, can you tell me a little bit about your business model? He goes, yeah, here's who we sell to, and everything we do is a 3-year contract. They've been in business for 2.5 years. It's like, well, what's your churn rate? He was like, well, like less than 1%. It's like, oh, so you had somebody cancel early, right? So really understand that customer lifetime value to CAC is only meaningful after you've had some real subscription renewal periods. Any question on CLTV to CAC? You see the benchmarks? If someone tells you 3, it's like, what are you, from 2015? It's an old benchmark, it really is. Okay, rule of 40. So rule of 40, once again, it's on the SaaS Metrics Board website. So how do you measure this? It's your top line revenue, and it can be GAAP revenue if you're a public company, or it can be ARR. Plus, EBITDA is the most common for smaller companies because people know what their EBITDA margin is, right? For larger companies, it's free cash flow percentage. So you take top line revenue and you add your EBITDA, and what they're saying is that should be 40 or above. This is 15 years we've been using this metric for SaaS investors. I'm going to show you in a minute why it's so important to enterprise value in 2023, where in 2022 it wasn't. As a smaller company, do you see the rule of 40 over there? See how high it is? You're like, how in the hell? Nobody's at 66%. Why? Because when you're a $1 million company, you're probably growing 300 to 200%, right? And you will have maybe a negative EBITDA of 40, 50, 60%, bootstrapped or equity funded. So the hardest part is once you get to that 5, 10, 15 million, your efficiency goes down. So be prepared for that. Okay, 1 minute. You also have the slides. All these metrics aren't the same importance while you're scaling. So you'll see right here, the check mark is you should be considering them. You should start considering instrumenting your source transactional systems, your subscription billing or your CRM. And then the check plus is you should be using these metrics to inform your decision making. And what's very important, and I know I got like less than a minute, the framework that I showed you up front, create your own performance metrics framework. What are those 3 to 5 lagging indicators that your investors really care about? It's the 5 I probably talked about. And then what are the leading indicators that directly impact that? Things like CAC Payback Period. It's going to be sales cycle time. It's going to be your ACV, and it's going to be your win rate. Those are 3 of the primary leading indicators that's going to impact your CAC Payback Period. Sales and marketing as a % of revenue is probably a 4th. So build your own metrics framework, starting with lagging indicators, the top ones that drive enterprise value, and then the leading indicators. And your head of sales, your head of marketing, your head of product should have objectives that are measurable that link to these. And if you have a North Star metric, understand how your North Star metric impacts one of these enterprise value creating metrics. And make sure everybody in your company understands that. Like DocuSign, it was number of e-signatures, right? That drove usage, it drove size of revenue, subscriptions. Okay, and the last one, R squared factor, it's a measure of correlation. And it's an eye chart, but just look at the last one that I have. Rule of 40 is about 0.3. It actually went down in the last 3 weeks, and growth is 0.38. So do not be fooled that growth isn't still being rewarded by the public markets and by private investors. But you can see how Rule 40 went all the way up to a 0.44. R squared can be between 0 and 1.0. So 44% of enterprise value to next 12-month multiples can be explained by Rule 40 versus revenue growth. And with that, if you want to participate in the industry's largest benchmarking program, it's just been kicked off. We're doing it with like 12 partners like Sage Intacct, Maxio, SaaS Optics, et cetera. You can participate, and it's 100% anonymous, and the value to you, by participating, you get free access to this interactive portal so you can see how your metrics measure up to your cohort. With that, I'm done. Thank you.
Thanks a lot, Ray.